Okay, so let's sketch out what this actually looks like. So if you have a copy of my book, Blueprint to Financial Freedom, what I want you to do is I want you to turn to, this is going to be page 78 of the paper copy. Ebook, I'm not sure, okay? But on page 78 of the paper copy, we're going to draw through together and sketch out the exact way that this car thing works. How do we self-finance a vehicle? So let me pull up my whiteboard and I'm going to draw this out with you guys. And again, I want you to be thinking about your car loan, your vehicle, because almost all of us have one, unless you've already done this strategy or you've been paying cash. If you've been paying cash, I want to submit to you that you're losing money, right? So this is still a better way to go, a better concept. Now on this example, what we're going to do is we're going to show an example of me, what I did using $60,000. This was with my old BMW. I no longer have it, but my X6, if you guys have ever seen that before. So if I want to basically buy a $60,000 car, that means that I need to have $60,000 available in my Sacred account. Okay. Which means I probably need to contribute like 70 grand, right? So if I contribute about 70,000 in contributions, that's going to result in me having 60,000 in cash value that I can borrow against. Right? So that's what we're doing so far. Now here in the book, it says we're going to buy the $60,000 vehicle. So basically I'm going to take this $60,000, which is growing. Again, this is growing at a plus of 3 to 5%. This is our growth. It's costing me 2 to 3% per year. This is our cost or our interest. Again, when I borrow money from a life insurance policy, I'm going to pay a cost to borrow from the insurance company. So it's costing me 2 to 3, but over the life of my policy, I'm making about 3 to 5% annually on average, right? So what I do here is I take this 60,000 and I buy my vehicle, right? So I buy my BMW X6, pay cash, right? Took the policy loan out, walk in the dealership, pay cash with the 60 grand. Now, the first thing I do is this vehicle that I'm paying cash for at 60 grand, I'm going to make a payment to myself, which is at a 2% of the total value that I've borrowed, right? So 2% of 60,000 equals 1,200 bucks. And I'm going to pay myself that over 5 years. That's 60 months, right? So I pay myself back over 60 months. And basically, while I'm doing that, my 60,000, actually my 70,000 is still growing at a 3 to 5% rate. Okay. And I'm paying myself that car payment just like I would with the dealership. Now, here's the deal. When I do this, the reason that I did an X6 is the BMW X6 qualifies for something called Section 179 and 168K in the tax code, which means that if I buy this vehicle for my business, I get to write off the entirety of the $60,000 against the profits in my business, right? So here in my book, I talk about, okay, so if I do the $60,000 deal, that's going to reduce my taxes by around $15,000 just off the top. Okay, I've saved myself 15 grand. Now, what I'm going to do on my next one, so let's fast forward. My next car is going to be a Audi. It's going to be an Audi e-tron is what it's called. It's like the BMW in size, but it's also electric, right? So I get to write off the 15,000 or whatever it saves me on my taxes. I also get a $7,500 tax credit because it's an electric vehicle, right? So I'm already stacking up around 20 to 30% of my initial investment is coming back to me immediately just in tax savings. Now, in addition to that, I have my 60,000 growing, which at the end of 5 years, it's going to be worth about 73,000. 73,000. I know that's an ugly 73. Let me fix that for you. Right. So my 60,000 after 5 years, because it's been growing, is worth around 73,000. Okay. Now the car after 5 years is worth about 30. Right. So if I add all of these factors up, that totals out to 118, 1 plus 75. So that's about 125 grand between what my cash value grows to, what I'm saving in taxes. On this one, I'm also getting a tax credit, plus the future resale value of that car at 30,000 at 5 years when I sell it or I trade it in. So I effectively took $60,000 and I doubled it in 5 years. Okay. That's basically a 100% return. That's over a 15% compounding annual growth rate. So I'm making more than 15%. Now, if you're watching this and you're smart, you're saying, well, yeah, but Jerry, it costed you interest. You had to borrow money. What's the interest cost? So let's factor that in. We don't want to leave that out, right? So over the 5 years, my cost of interest is $4,753 and 83 cents. Okay. So if we subtract that out, let's even just call it 5 grand. I still doubled my money. Okay. So this is still 120,000 that I have in final value between what the car is worth, what my cash value is worth, what my tax rebates are, what my tax deductions are, minus my cost of interest to borrow. I still have 120 grand. Right. So I've still made like 14, 15% on this. This is probably close to about a 14%, give or take, annual return over 5 years. Okay. So again, let's look at the difference here. The difference is I finance it, right? I finance it and then I actually pay money. And at the end of it, I have a car that's worth less than I paid for it. And I paid a bunch of interest and income to a bank. So I'm losing. Let's say I pay cash. I pay cash for it. I don't pay any interest, but I still took my 60,000 and turned it into 30 because the car is worth half of what I paid for it. But if I do it this way, my money doubles. You guys see that? So this is why this is important. Now, the final thing I want to cover on this is, again, we have to look at the scale of things. At the top, we have earning interest. At the bottom, we have basically a 0 point. We don't make, we don't earn, right? And at the very end, we have cost. Okay, so we can either have an earn, we can have a 0, or we can have a cost. So a lot of times what happens is people will look at a car loan and it'll be really, really low interest, or it'll be 0. And they'll be like, man, well, that's what I call free money. It's not free. It costs you your income, right? But let's go ahead and go with the free money mindset, right? That's what I call free money. Okay. So you take the free money, right? You finance $60,000 worth. You're going to pay a bank $1,200 a month for the next 60 months, all so that you could keep your 60 grand. Okay. Well, if you go invest that 60 grand at 12%, you're only going to make $600 per month. Your car costs 12. So you took advantage of the free money. Free, right? Even if it was at 0% interest, it's not free because you're still losing. You take the 60 that you kept because you didn't use your money, you used the bank instead. So you still got your 60, you put it into a deal, you make 12%, $600 a month, but your cost on the car is $1,200. So at the end of this, you're actually coming away with less money, even if you use the cheap money or the free money, right? So there's really no such thing as that. Right? So we don't want to look at cost. We don't want to look at net zero. We want to look at earning. And the only way to truly earn on a car loan is to do it this way. There's not another way to go about it. Okay. There's a reason why this is called the top 1% of wealth. This is how people think in that bracket and in that area of financial life. So none of your peers are going to be doing this. None of your friends are going to be doing this. Your buddies that are kind of into finances, they're going to look at you like you're stupid because you didn't take the cheap money or the free money. But you can look at the math and realize you're right. Doubling your money is about the most right you can be with finances. So guys, that's all I have for you on this one. We'll see you in the next segment.